How we doing, everybody? Welcome to Chapter 5, the strategic role of information in sales management. This is another long, meaty chapter, but I'm going to see if I can do my best to break it up into some more macro, big picture topics. Now, the chapter talks about bringing information technology into perspective. I think a better way to think about this is a scientific process to the process of being a sales manager. So, for instance, we want to look at market potential, sales forecasting. We would use information to help us make some of these decisions. Such as creating a sales forecast, figuring out what is a territory worth, or how should we assign people to that territory, setting quotas for our sales force, and finally, how do we design a territory. Broadly speaking, if we need to make some kind of a forecast, because the forecast helps us with figuring out what the opportunity is for that potential market. So we're looking at the potential of the marketplace, the sales potential, market share. What could we achieve within given these two first variables? And finally, setting some kind of quotas, giving our sales force. Now, the first part of the chapter goes very detailed into sales forecasting methods. I think for the purposes of our class, I think you should just have an idea that we used forecasts, and we need forecasts in sales management. Going through the pros and cons of each one of them, if you need to cross that bridge, you just come back to the text. Okay? If you're working right now and you have any more specific questions about them, I'll be happy to go through them with you. For now, this is just a broad overview. So when we're talking about our sales forecasting methods, we have subjective ones and we have objective ones. That's the way I would like you to think about it right now. Subjective means we have the managers and or the sales force come up with the forecast. Objective ones is we use statistics. We use some kind of a formula and we come up with a number that has less subjectiveness to it. It's more mathematical. No one method is really superior under all conditions. Many firms apply multiple forecasting methods to come up with sort of like a moving average or some kind of an average. I mean, think about what you're trying to do with forecasting. You're trying to predict the future. There's no way in the world to predict the future. But if you don't plan ahead for something, your best guess, your best forecast, then how do you know to align the sales force? How do you know which resources you're going to need? If you don't give it a shot, to use the vernacular, then 3 months into the quarter, you're not going to have the resources because you didn't plan ahead to do that. Some things to think about for territory estimates. Okay? We have to design procedures of how to identify customers within this territory. We establish quotas. Within that, there are different compensation and subcomponents too. And finally, the overall valuation of sales performance. Now, to help plan ahead, well, how do we come up with some of these numbers? Well, they used to be called SIC codes, but now it's a better number than that. That's more detailed. We basically can find out the total population of customers. And pretty much any library, and depending on how much you pay online for a database, you can get an NAICS classification. You also can come up with some kind of a buying power index. Sales and Marketing Magazine does this. It considers income, population, retail sales. More useful in retail environment, consumer price goods, not high-end B2B. Okay, quotas. Quotas are assigned to an individual salesperson, usually on a quarterly, but sometimes it's a monthly basis. Regardless of what they're assigned to, they do have a specific time period. Your tool for it's your main tool for planning and controlling what's happening in the field. You expect salesperson A to achieve this particular number. It's a benchmark for evaluating how effective they are. And it's what motivates salespeople, because they know that if they want their full salary and their full bonus, that they got to make that quota. Now, it does provide the incentives and the motivation for the sales representatives, and it's mainly there for the sales manager to help evaluate for performance. But the quota also ties back to the forecast, where one of the other purposes of the quota is, you set the quota based on expectations from the sales forecast. There are different types of quotas, so you need to select the quota that's a best fit given your context. Some good characteristics of quotas. Quotas need to be attainable. They need to be reachable. A quota that's out of whack, you'll demotivate the salesperson, because they know they have no way, shape, or business possibly achieving that goal. If they had 3 salespeople in the field with them at the same time, and each one of them was Superman, Superwoman, Batman, they couldn't achieve the goal. A quota needs to be easy to understand. It can't be too complex. It needs to be complete, no vagueness, and it needs to be timely. It has to have a specific time function associated with it. So a lot of them are on volume, quota types. So it could be emphasized sales volume. Some of it could be an activity quota, like reaching a certain number of customers each week. Some of them could be a financial quota, because some products have higher profit margin than others, and maybe you might not have the sales volume, but you are more profitable than some of your other salespeople. So volume quotas tend to be the most popular. They usually are based on historical sales data. I mean, if your quota is 100 units to sell, then it's, that's very clear. It makes sense. Okay. And usually what happens is the cost and margin associated with each sale. There's 100 units in your quota. We know it's 30% margin. That 30% margin represents X number of dollars. That's how much profit. This is how much cost. This is how much fixed and variable we're expecting for this 3-month period. And you use that to go forward. It's usually expressed in dollars, or sometimes it's units. Some firms do a point system, but usually it's units. Okay, here's some activity quotas. It could be a function of the territory. It could be, someone's activity quota if you're a pharmaceutical rep for Manhattan versus your activity quota for someone who's a rep for, say Kansas City. There's more hospitals and more doctors in Manhattan than there are in Kansas City. So you could say that we expect higher activity from the Manhattan rep. It does reflect territory conditions. It does impact how big the accounts are, how orders usually come in, purchasing patterns for those accounts. Sometimes there's satisfaction numbers associated with that. So here's a list of some common types. The number of calls on new accounts, number of letters to potential customers, number of proposals submitted, or like requests for proposals. the number of field demonstrations, the number of total calls, the number of installs supervised, displays, this tends to be with retailers, how many meetings were held, how many conventions attended, what's your past due, so of the people in your territory, how much of that money is not what's weird, I'm thinking about this sure seems like the next category, which is more financial. The goal is to direct salespeople to more profitable products or customers. So it's either based on margin or some kind of a net profit or overall selling expense. These calculations are not all that straightforward. It's easier to think about volume. That's very straightforward. Financial quotas are not as straightforward. Sorry. There's many things that could impact profitability beyond a salesperson's control. Some things to think about when we're talking about quotas, the territory itself. Is there enough potential in that particular territory? Is there enough clients in that particular territory? How the quotas impact on motivation overall, especially if it's unattainable quotas. Long-term company objectives. And finally, short-term profitability. Usually you have the forecast is where the long-term comes in, and then the short-term is more the management of what actually happened. That's how I like to separate these two: forecast versus actual. So now, one of the other things that we do with information is we have to figure out how to deploy our sales force. Some of the things that we would think about, how big or the number of territories a salesperson or a sales team might have, how complex those territories are, Manhattan versus, say, Boston, say, versus Tampa, or Manhattan versus Tampa, allocation of total selling efforts to accounts, and then sometimes some of the efforts can be done through software. So we're on page 160, 161. So we're looking at how do we determine sales force size. There's no one great method, but there's a couple good ones that I'll briefly touch on the book, that were highlighted in the book. So if we look at the breakdown method, how many salespeople do we need? We have the sales forecast, and we have some estimate of productivity based on, it depends on how you want to define productivity, but I'll have a couple slides later where I'll show you an example. But this is based on historical records of salespeople. This is the forecast that is given to the company, however it is determined. And based on this is the number of salespeople that you need. Workload is if you have more information, okay, and you're looking at the total number of hours, and you're able to have a pretty confident calculation of, given your product, service, and marketplace, you're doing it by an hourly kind of a scenario. And then how many hours does each salesperson really have to this particular task? Based on this number and this number, we get the total number of salespeople. Finally, we get the incremental method. And I know the book kind of bashed this one a little bit, You basically add a salesperson until there's no more incremental profit in that marketplace. If you have a salesperson in the marketplace and they keep saying, I can't get to all the accounts. You add another salesperson to that marketplace and sales increase. If you had a third and nothing else increases, then guess what? Maybe somewhere between 2 and 3 salesperson is probably the optimal. You would go with 2 or 3, and that's how you would determine. You're basically looking for decreasing marginal returns. So here's a little spreadsheet, the number of salespeople. If we look at total revenue jumps here, you notice how we see a decreasing each salesperson. you know, the amount of increase is dropping and the amount of profit goes up, but it's also slowing between here and here versus here and here versus here and here. The change between these are getting smaller, as indicated by this. You can almost see that 4 might have been too much, because also each time you add a salesperson, it's the additional cost of $50,000. So, you know, every time you add a salesperson, you're adding $50,000. Well, did we get enough profit to cover the salesperson? You know, here, no, here, no. So really, somewhere between 2 and 3. You would probably stop at 2. Something else to think about in terms of markets. Well, the Super Bowl was here in this marketplace right here. It is the largest in the United States. Not surprising that this was the biggest Super Bowl in terms of viewership. You know, almost 19 million people in the greater New York City area. LA is second. Chicago is third. Dallas is fourth. Philly, there we go. But Philly and Houston, that greater Houston area, I believe Houston's actually past Philly right now, to be honest with you. Philadelphia is not growing the way it was growing, and Houston is growing quite rapidly. Washington, Miami, Atlanta, and then Boston. These are the 10 largest markets in the United States. You would obviously want to try to feed more salespeople in the direction of where there's more potential customers, depending on your product or service. Here is a matrix, and we think about account potential. Is it high or is it low? And then we look at our competitive strength in that particular industry. Do we have high account potential but weak competitive strength in that category? Well, that's not a good matchup. Hopefully it's high strong. This is probably the best quadrant to be in here, if possible. So we do this kind of analysis. We're gathering our data. We're comparing historical sales data. We look at concentrations in products, customers, orders, and territories. We might use the Pareto principle, also known as the 80-20 rule, where we try to assign 80% of our sales force. We're trying to get the most revenue given our sales force. 80-20 means 80% of your revenue comes from 20% of your customers. So then we use this information going forward. So when we're doing this sales analysis, we have to think about the sources of information, how it's aggregated, and the types of evaluative systems. Sometimes it's simple, straightforward. Sometimes it's comparative. Like quota of last year versus this year. You might be compared against all your other salespeople. But we're looking at invoices, call reports, expense accounts, warranty cards, satisfaction, customer relation management, system stuff, enterprise software planning, resource planning. And then we're doing this by geography, by product, by package, by customer size, by sale, by order. So based on this information, we come up with this overall comparison. We saw simple versus comparative. We just saw that in the previous. Here, when I said I would show you performance index, here is the performance index set by this firm, and it's basically a function of percentage of quota. So if the quota was 700, they achieved 760. They're 108% over quota. Here, where someone didn't meet their quota, they were under their quota, obviously it's less than 100. 100% would be meeting quota. Anything over 100%, 8.7% over, 15% over, 8% over, 2% over. That's a performance index. We talked about aggregating. This was here in that slide here. And then finally we have several sales type reports. We can do this by region, by office, district, product. This is the bottom half of this graph here. Lot to do there in Chapter 5. I hope Chapter 5 was good for you. I look forward to answering all your questions. Thanks.